top tips for the young investor in 2020. The economy is at a standstill. The employment rate is continuously declining. There is no sign of the economy crisis ending anytime soon. Worst off, stock prices are on the increase. What? Stock prices rising when the economy is in recession? What is happening in the stock market? According to an NAB trade, the number of young people creating new trading accounts in Australia has increased by more than 360%, while trading volumes doubled between March and May. For instance, in the last 4 months, a US-based investment platform, Robinhood, recorded a significant increase in their membership base, with the average investor being 31. What else could be responsible for the sudden interest of young people in the financial market, if not to invest to secure their future? If you're a young investor and don't know where to start investing, this episode will give you the needed direction. 1. Work on your psychology. To be successful as a young investor requires skills like the abilities to determine the direction of the stock's trend and evaluate a company's fundamentals. But neither of these technical skills is as important as an investor's psychology. There are two main emotions to understand and keep under control: fear and greed. Don't be too quick to dismiss psychology as a factor in your development as a successful investor. Not controlling the emotions you might experience, such as fear, greed, pride, ego, or denial, may impact on the way you invest and, more importantly, on the decisions you make concerning your investments. So, work on your psychology before you start your investing journey. 2. Begin your investing activities as early as possible. When you're in your 20s, it's easy to think you have all kinds of time to get your financial life together. You could easily live another 60 or 70 years, right? The younger you are, the less likely you're to have burdensome financial obligations, a spouse, children, and a mortgage, to name a few. Without these burdens, you can allocate a small portion of your investment portfolio to higher risk investments, which can return higher yields. When you start investing while you're young, before your financial commitments start piling up, you'll probably also have more cash available for investments and a longer time horizon before retirement. With more money to invest for many years to come, you'll have a bigger retirement nest egg. To illustrate the advantage of investing as soon as possible, assuming that you invest $200 every month starting at age 25, if you earn a 7% annual return on that money, when you're 65, your retirement nest egg will be approximately $525,000. However, if you start saving that $200 monthly at age 35 and get the same 7% return, you'll only have about $244,000 at age 65. This is the magic of compound interest, a phenomenon Albert Einstein once lauded as the eighth wonder of the world. 3. Learn to save rather than spend. You can't be a successful investor unless you're an investor, and you can't be an investor unless you have some money to invest. To do that, you have to save some money instead of spending every dollar you make. Is that so complicated? Yet you would be amazed at how many people just can't seem to set money aside for the future. Your friends want you to spend. Nike wants you to spend. Starbucks, Apple, your cell phone company, all want you to spend. You know the list better than we do, and you know it simply doesn't stop. So right away, to be an investor, you have to do something that almost nobody in the world wants you to do. Save some of your money instead of spending it. How do you do this? Nike said it best, just do it. This one is totally under your control. Nobody can stop you from saving, and nobody can make you do it. Here's a guarantee: if you save some of your money and put it away for the future, you will never be sorry. Here's another guarantee: if you don't save some of your money and put it away for the future, someday you will wish you had. 4. Diversify your portfolio. Everything in life contains a certain amount of risk, and this is especially true when it comes to investing. The idea of diversifying is to select stocks across a broad spectrum of market categories. This is best achieved through an index fund. Aim to invest in conservative stocks with regular dividends, stocks with long-term growth potential, and a small percentage of stocks with better returns or higher risk potential. If you're investing in individual stocks, don't put more than 4% of your total portfolio into one stock. That way, if a stock or two suffers a downturn, your portfolio won't be too adversely affected. Certain bonds are also good investments for the long term, either corporate or government. Long-term treasury bonds, for example, are safe and pay a higher rate of return than short and mid-term bonds. Remember, don't put all your eggs in one basket. Holding a diversified portfolio of stocks, bonds, and other assets that are exposed to several sectors of the market lowers your odds of losing a ton of money. 5. Get to know the taxes and inflation. Investing is not just about finding stocks, bonds, and other investments that will rise in value. You must not ignore taxes and inflation because they can have a dramatic effect on the growth of your investment. The way that inflation and taxes work in tandem to hurt your true rate of return on your investment can negatively impact your future earnings. To see how this works, let's start with a basic example. Say that you invest $10,000 and earn an 8% pre-tax return. You're in the 25% tax bracket for federal purposes, and you also have to pay state income taxes of say 5%. Inflation runs at a 3% rate over time. When you look at the result, you'll find that what at first seems like an 8% return is actually closer to 2.5% after taxes and inflation over a 10-year period. Therefore, make sure you understand your tax policy and operate a tax-deferred account instead of a tax liability account because it creates wealth faster than the latter. 6. Don't ignore the fees involved. All investments carry costs: trading fee, management fee, annual maintenance fees, brokerage fees, advisory fees, international currency conversion fees, transaction fees, as well as fund management fees, among others. Paying excessive fees can eat up your overall returns on investment. So, as you build your investment portfolio, be sure not to ignore these fees. It's always important to ask your advisor and brokers about their fees and be informed on all the ways you're paying for their services. 7. Invest in yourself. No matter what happens with the stock market or the price of shares, there is one area of your life where you have total control. The number one place you have total control with your investments is in yourself. Therefore, learn from the mistakes of experienced investors to cut down on mistakes. Invest in your personal, professional, and financial growth in whatever ways you see fit. Why? Because investing in your work ethic, skill set, or wealth of knowledge could be the best investment you'll ever make. Read as many books as you can and attend conferences that support your growth. More importantly, be sure to apply the best advice to your daily life. Few things can land you an increase in pay or new opportunity quicker than highly developing your skills. When you invest in yourself, you simply cannot lose. As a young investor, it's still not too late to go back to school, earn an important certification that could advance your career, or start over in an industry you've always admired. 8. Don't panic if you lose money. Successful investors usually lose money and get over it. They understand that it's impossible to make money from investing without losing it. Market corrections and economic downturns do not go away, as the COVID-19 shows, but do not despair. Do not let emotions like panic, fear, and anxiety cause you to make the rash decision to sell into a falling market. Why? That's because after every decline in history, no matter how severe, investors tend to recover their losses and markets begin to stabilize and see positive growth over the long run. 9. Investing may not be for you, and that's okay. Before you make any investing decision, sit down and figure out your goals and risk tolerance. Let's face it, not everybody can manage their own money, and there's actually nothing wrong in that. If you don't have the risk tolerance, you won't enjoy investing. Instead, you can settle for market returns while maintaining low fees. 10. Go easy on yourself. It doesn't matter how productive you are, if you don't take it easy on yourself along the way, you may end up not achieving anything. As humans, we have a greater flexibility of reinventing the wheel, and what seems like a mistake might be an opportunity for you to re-strategize and bounce back. Remember, time is on your side. So, think of long-term investments and don't be too greedy as you climb the investment ladder. That's it for this episode. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Good luck and see you in the next episode.